Today's episode is sponsored by Trading 212, the platform bringing commission-free investing to everyone. The Japanese and US governments just spent an estimated $80 billion propping up the yen, and within a fortnight, the market had pocketed half of it. Welcome to the oldest fight in finance, politicians versus the market.
I want to know whether the powers that be can ever actually beat currency traders. And in today's dumb question of the week, why can't the government just pick whatever exchange rate it likes? All right, let's get into it. So this week, we're asking that old chestnut, what's going on in Japan? Something you could have said every day for the last 40 years. But in this instance, we're looking at the yen and a quite spectacular intervention in currency markets.
Now, you might be thinking, why is this relevant to UK investors at all? But it is worrying people. So, for example, we have every 2 weeks a call with our members on PensionCraft, and a lot of the questions were about exactly this topic.
What is it that's concerning people?
I think it's instability. Is the volatility from this intervention and the reasons behind it going to spill into the UK and make my index fund fall? I guess that's really the nub of it.
I mean, Japan has form, doesn't it? It was only a couple of years ago where we saw the biggest one-day crash in the Japanese stock market ever, I believe, which was due to this thing called the carry trade and the fact it was unwinding.
Now, maybe we should explain what the carry trade is. Do you think that's a good idea?
It's always a good idea. We explain it and then 5 minutes later, everyone's forgotten what we said.
Okay. But the idea here is simple. You have currencies which have low interest rates, currencies which have high interest rates, by which I mean that the fixed income stuff in that currency has low rates or high rates. So why not borrow in the low cost currency, the low rate currency, and then park that money converted into the right currency in the new fixed income market with a higher interest rate. And that way you pocket the interest rate differential. And then on top of that, you put some kind of currency hedge. So if there's still something left at the end of the day, why not lever it up? Because then you could get even more juice out of the trade, which is great. It's like free money.
So in this instance, Japan is obviously a relatively low-yielding market. So you borrow cheaply in yen, you then park the money in higher-yielding dollar assets, and then profit from the gap.
Yeah, it's great. And look, what could the risks possibly be?
Well, is the risk that the Bank of Japan starts raising rates and your profit gets eroded away and traders rush en masse to unwind the carry trade?
Yep, and unwinding a leverage position never ends particularly well. So that's what the history of the carry trade's like. People put on this trade, they lever it up. Usually hedge funds do this. And then when something bad happens, it could be volatility in currency, which pushes up the cost of the hedge. It could be interest rate differentials moving. That usually happens more slowly. But something happens which essentially breaks the trade and causes huge dislocations as hedge funds have to rapidly unwind their positions.
So in August 2024, the Nikkei 225, which tracks the Japanese stock market, fell more than 12% in a single day. It did then rebound almost as fast. But if you're asking why people are nervous, well, that's the reason, isn't it?
And it's worthwhile pointing out something which is kind of obvious, which is that if you're selling yen to buy dollars in the carry trade, well, that weakens yen versus the dollar. And if that thing reverses, what happens is a very rapid appreciation of the yen versus the dollar, if that was a currency pair that people were using.
And I'm glad you mentioned the yen, because what we've seen is the yen weakening dramatically over the last couple of years, which has then led to what happened a couple of weeks ago, where in an almost unprecedented step, the US and Japanese governments coordinated to defend the value of the yen, i.e. they were buying yen and selling some other currency in the market. Now, this is the first coordinated yen buying operation since 1998, I believe.
And in terms of the monetary amounts used, Japan was by far the biggest player here. Look, it's defending its own currency. You'd expect that. And for the US, it was a token amount. And in fact, there's a nice picture that I saw in the FT of a notepad in front of Scott Bessent,
Yeah.
which, which said, buy yen.
Didn't it have the ticker in brackets after the yen?
JPY, always good to remind yourself in case you'd forgotten. This is a guy who worked at Soros's hedge fund, of course.
Which we'll come on to later, because you can't talk about currency interventions without talking about George Soros.
And there was one thing which he left out on that notepad, which we'll probably come back to as well.
Well, let's go for it now. If you're going to buy a currency, you've got to sell another currency. And usually, if the US was going to intervene in currency markets in this way, it would sell some dollars and buy some yen. That's not what it did.
So what they actually did was to sell euros to buy yen, which the ECB, I suspect, wasn't too happy about.
It's one thing to sell euros to buy yen. It's another thing to do that without telling the ECB in advance. No warning.
Now, you might be thinking, why would the US do that? Why would you buy something with someone else's credit card and not tell them about it? Well, one of the reasons, which is kind of interesting, and it says a lot about the state of the US right now, is that the US is trying to operate a strong dollar policy. It wants to keep the dollar strong. And if it sold dollars to buy yen, that would have weakened the dollar. So that's one reason. And I think what this also signals is that the US is willing to intervene in order to prop up the yen, which it said was out of friendship, but I suspect there may be other reasons involved.
Yeah, I'm not sure this current administration in the US really has friends. It has counterparties and transactional buddies that are temporary. But if you read between the lines, it seems to be that the thinking was that the yen had weakened dramatically, far too much to be justifiable. And in fact, if you look at it on a trade-weighted basis in real terms, before this intervention, the yen was at its weakest level in the entire history of the floating rate era. So it was serious, and it's been depreciating over the last 2 years, even though the interest rate differential between the US and Japan has narrowed. So you can't explain all of this weakening via the carry trade.
So what else could have been responsible for yen weakening? Well, it's probably a result of policy decisions by the Japanese government. So, for example, PM Takeichi decided to do a large fiscal stimulus package. And at the same time, you've got the Bank of Japan hiking very slowly. So overall, markets read that as being inflationary. And remember, Japan had deflation. It was flirting with deflation for nigh on 30 years. So on the face of it, you'd think that's good news. We finally got inflation back, but maybe a bit too fast. And the Bank of Japan is in a bit of a bind, because if it raises interest rates too much, and with debt to GDP ratios at 250%, that could make the cost of funding Japan's debt really a problem for the economy.
But the one thing we haven't answered is, why does the US care? Why is it acting in friendship with Japan here? Well, here's the theory. A weak yen, all else being equal, means that traders will sell Japanese government bonds. And that has ripple effects across the world, where the global term premium, i.e. the cost of long-term borrowing, rises for everyone. And the US really doesn't want that right now. Its 30-year bond yields are the highest they've been since the financial crisis. So you could say the US was trying to defend the treasury market by boosting the value of the yen. What do you think?
Yeah, I think that's one of the reasons. And I think it wasn't discussed by Scott Bessent, for example, but I think that's the actual story. Now, Japan holds over $1 trillion worth of US debt, so it's not a small stakeholder. So if it did have to sell its treasuries in order to generate dollars, which it could then use to buy yen, that would be a big problem for the US treasury market. At the same time, we've got Kevin Warsh, the new Fed chair, who has made a little bit of a hash of it so far. Maybe he's going to come good later on, but you could argue that some of the rise in yields in US treasuries was due to his pretty unimpressive meetings when he was talking about Fed policy. And there's another reason why US Treasury yields are so high, which is worries about sustainability of US debt. The debt to GDP ratios are gradually creeping upwards, and that's because of a consistent fiscal deficit. The US continues to abuse its privileges in terms of having the deepest and most liquid government bond market in the world by issuing too much debt. At the same time, the US has chosen to upset its creditors, the people it owes money to, by launching things like trade wars, cutting defense relationships, and basically upsetting the geopolitical apple cart, which on the face of it isn't a great idea.
And if you're talking about who the US owes money to, Japan is the biggest foreign holder of treasuries. You hinted at it there, $1 trillion worth. And the one thing the US doesn't want right now is for Japan to start selling that down, obviously. That would only push up yields further. So handily, the US has come up with a means by which Japan can raise dollars without selling down its US bonds. And this is something called FEMA, the Federal Reserve's Foreign and International Monetary Authorities, which they didn't use this time, but Scott Bessent has hinted that if they do this kind of thing again, might be used. And it's basically an emergency measure, a kind of last-ditch thing that came out of COVID, whereby foreign central banks can borrow against their treasuries for the short term to raise dollars.
So think of it like a pawn shop where temporarily, if you need cash, you've got stuff, you can hand over the treasuries and get cash. It's a short-term agreement. It is overnight, in fact. You have to keep rolling it. And the rate that you pay is slightly punitive, but essentially it works, right? You hand over the treasuries, you get the cash. But the critical thing from the point of view of the US is you're not selling those treasuries. It's a temporary repurchase agreement.
Again, I think this is signalling. It's saying to the currency markets and the bond markets, look, if we want to, we can keep intervening whilst minimizing the blowback in terms of borrowing costs. But maybe we should ask the obvious question, has this initial intervention worked? I think it did initially. So before the intervention started, you get around 164 yen for a US dollar. The yen then strengthened to around 157 per dollar. But as we said in the intro, it's since given up about half of that move.
So you can do these things called purchasing power parity models, where you look at the interest rate differential and you can say, given this interest rate differential, the current stable value for this currency should be that. However, there are usually really long-term deviations from that fundamental value of the currency. So people only ever use it as a direction of travel. But if you do these models for the yen, almost by any measure, it was looking cheap. So you could argue, I'd say, that it's almost like trying to make the tide go out faster. Of course, you can try, you could bulldoze shingle around on the beach, but what's the point if that's the direction of travel anyway?
So you're saying the yen is very undervalued. By some models, if you look at purchasing power parity, it's maybe 40% undervalued versus the dollar. To me, that seems extreme. There are other models which say it's more like 12 or 15% undervalued. But say every model says it's undervalued to some extent, you're saying, well, just wait for markets to do their job over the long term. These worries about Japan's balance sheet and inflation will subside over time.
I wonder what kind of timing mechanism could be involved, Michael. Potentially something political.
There's always something political, though, isn't there? I guess the US has elections this year.
Oh, yeah, that was it.
You think it's all about that, though, do you? Genuinely?
I genuinely do think that's part of the reason behind this. Maybe there was some element of the US actually wanting to help Japan, but I think given the history of this government's decisions, that's unlikely.
I think it probably says they're more worried about the bond market than they let on.
Yeah, if there's one thing which has affected the decisions of this government in the US, it has been the bond market. That's what's essentially made the US step back from some of its policies, particularly for trade.
The bond market is everyone's master in the end, isn't it? But it's a brave or a foolhardy government that decides to step into currency markets in size. These things certainly don't always work. In the second half, let's look at some of the notable examples from history where governments have tried to bully the FX market and whether they've worked.
Today's episode is sponsored by Trading 212, the platform bringing commission-free investing to everyone. Trading 212 Stocks and Shares ISA is the cheapest way to invest, with zero commission and one of the lowest FX fees I could find on the market. Looking to keep things simple, you could easily automate your investing with pies that allow you to rebalance your portfolio at the click of a button. Customers with Invest accounts can also benefit from the Trading 212 card, which has no FX fees and true interbank rates. Many Happy Returns listeners can claim free fractional shares worth up to £100. Just create and verify a Trading 212 Invest or Stocks ISA account, make a minimum deposit of £1 and use the promo code RAMIN, RAMIN, within 10 days of signing up, or use the link in the show notes. When investing, your capital is at risk and you may get back less than invested. Past performance doesn't guarantee future results. Pies and Autoinvest is an execution-only service, not investment advice or portfolio management. Automatic investing refers to executing scheduled deposits. You're responsible for all investment and rebalancing decisions. Free shares can be fractional. 212 cards are issued by Paynetics, which provide all payment services. Trading 212 provides customer support and user interface. Terms and fees apply.
Okay, so we've looked at the fact that the US and Japan have collectively dipped their toe into the water in terms of defending the yen. The first time they've really done that in almost 30 years. But history is littered with examples of governments trying to run roughshod over currency markets. Now, this can go either way, can't it? You can defend a weak currency, and to do that, it means selling your foreign exchange reserves, of which you have a finite pile, or you can be seeking to weaken a strong currency. Now, there, the pile is not so finite because the printing presses can run through the night.
And another aspect of this is whether you're an exporting country or an importing country. Now, the US, clearly, mostly imports stuff. That's what it's complaining about with a trade war. That means that it has very little in terms of FX reserves, whereas a country like China has huge FX reserves, smaller than they used to be, but huge nonetheless.
So is that the firepower then? If you're trying to defend a weak domestic currency?
That's exactly right. So you bet that the market knows how much firepower you've got. There are lots of publications which you can find from any investment bank saying this is the amount of reserves that this country has. So you know how much a country's willing or able to spend easily in order to defend its own currency.
Perhaps the most famous example of currency intervention in history is the Plaza Accord from 1985. And this is one where it actually went exactly as politicians hoped it would, I think.
And I think this shows that it doesn't have to be about threats. You can do this thing via charm. And President Reagan was actually very charming to the Japanese delegation who came to Washington, and they agreed to the Plaza Accord. So this was agreed on both sides. Now, I think a bit of macroeconomic context here is quite useful. The dollar had strengthened massively over the course of the 80s. And the idea here was that because the dollar had strengthened as the interest rates in the US had gone up, the agreement was to actually weaken the dollar by selling it. So the dollar had risen about 50% in the first half of the 80s. Huge increases that went hand in hand with the Volcker period of very high interest rates.
And what's the worry there with a strengthening dollar? Was it that US exports were becoming far less competitive?
That was certainly part of it. And obviously, at the time, Japan was an exporting powerhouse. It was just starting to really dominate things like car exports, for example.
And electronics.
And at the same time, Reagan had deficits. So there aren't certain analogues with what we have now. And it worked unbelievably well. So the dollar fell about 40% versus the yen and the Deutschmark over a period of 2 years.
So why did it work so well? When government intervention in markets doesn't always go to plan.
Again, kind of like the yen, the US dollar was hugely overvalued at the time, so it was pushing in the right direction as fundamentals. It was also coordinated by both sides. That was a huge benefit. And of course, monetary policy was pushing the same way. So it was coordinated, it was credible, and it went from an extreme overvaluation to something that was more reasonable.
You know, some people say it worked too well. And there was another accord in 1987, the Louvre Accord, which was trying to make this dollar weakening stop. And that worked less well.
Interestingly, this was the same people in 1987, but it was the opposite goal. So the dollar had fallen so far, they needed it to stop. So what they agreed to was essentially to freeze rates where they were at the time. This was all about stabilization. Unfortunately, however, this one failed, and the dollar kept sliding through the course of 1987.
Yeah, it's easy to start an avalanche. They're harder to stop, though, aren't they?
And in terms of consequences, some people think that this actually contributed to Black Monday, which was the October 1987 crash.
Black Monday is one of those strange events where whatever your priors are about markets, you layer that on as the reason for Black Monday. Everyone thinks they know the reason.
Nobody knows, yeah.
No, exactly. There's probably a million different reasons, which is what makes it so interesting. But let's cross the Atlantic now. Let's move away from the dollar. And let's look at when things went wrong for the Bank of England and the British government. Another dark day. This is Black Wednesday in 1992, where the UK infamously crashed out of the European exchange rate mechanism.
And again, a bit of macro history here, which explains what was so difficult about this. After German reunification, the Bundesbank, the German central bank, had to run high interest rates. At the same time, Britain was in a pretty bad recession and we needed low interest rates. So obviously that's going to create a tension, which is not really resolvable.
Well, it would be resolvable if exchange rates were allowed to float freely. But the ERM did not allow dramatic moves between currencies.
And there was a notorious interview with Norman Lamont, who was the unfortunate chancellor at the time, where he said Britain will do whatever's necessary to hold the rate. Unfortunately, it was all mouth and no trousers because he didn't have the money to actually defend it.
And the pound had been pegged too high against the Deutschmark, basically. We were trying to defend an overvalued peg against the fundamentals, as you said, with finite reserves, and we'd drawn a political line in the sand. Speculators saw all that and took advantage.
And I've heard even the Queen was interested in what was going on. That's how bad things were.
Well, her face is on the money. She's got to care.
And she actually asked one of her advisors whether speculators could really succeed. And the person replied, "Yes, madam. In a system of fixed exchange rates with high differentials in the rate of inflation, they can." So even Queen Elizabeth knew that this was not defensible and that the speculators could break the exchange rate mechanism.
Who's that advisor? Let's get him back in government. That was a succinct explanation here. But it all kicked off, didn't it? So the Bank of England basically spent billions of its reserves and was hiking rates from 10% to 12% in the morning. Then it announced it was going to go up to 15% the next day. But in the end, the UK crashed out of the ERM in the evening.
And this is the really famous episode which got Soros's name as the man who broke the Bank of England. And his quantum fund made about $1 billion doing so.
Betting against the pound.
For the Treasury, not so good. They lost £3.3 billion. However, it's not just a disastrous story. It turned out that devaluation actually fed into a period of really good expansion for the UK. So maybe it wasn't a bad thing that currencies floated to where they should be.
I will always say that the 90s was the UK's greatest decade. Partly because it's when I was young, coming into my teenage years. But also life was better back then, wasn't it? But anyway, let's not dwell on the past. Where should we go next in our currency tour around the world? How about Switzerland? They got a lot of money, haven't they?
Yeah, and I remember this one because I was working at a Swiss bank at the time. And this is one of the examples where it didn't work. So again, let's set the scene. We had the Eurozone crisis where it looked like debt wasn't sustainable in the Eurozone. That was causing huge volatility in FX markets, but also in rates markets. And the safe haven at the time, as it is always, was Switzerland. And they don't like it. because what usually happens is people buy Swissies, Swiss francs, and that pushes up the value of the currency. And Switzerland's a big exporting country, so this is really bad news for Switzerland. Now, the Swiss National Bank declared that it will no longer tolerate a euro Swissy exchange rate below the minimum rate of 1.2. So it drew a line in the sand, and you can probably guess what happened next.
Well, eventually, the tide came in and washed away the line, but it did hold for 3 years first, didn't it? It was kind of an intermittent success. But then eventually, the Swiss had just had enough, hadn't they?
So again, there were two parties with very different goals here. So the European Central Bank saw that yields in the Eurozone were super high, particularly for the peripherals. So by buying government debt, it could push down those interest rates. However, that would have destabilized the Swiss franc even further. And the winner in these conflicts is always whoever has the most firepower. And the SNB couldn't compete with the ECB. Now, the signalling was unfortunate because the SNB vice chairman, Jean-Pierre Danthine, publicly called the cap the cornerstone of our monetary policy. That was 12th of January 2015. Then 3 days later, you can probably guess what happened. The SNB scrapped that floor. People call it the Frankenshock.
It was dramatic, wasn't it? The Swiss franc surged like 30% in a day against the euro, busting a load of FX brokers.
Yeah, Euro Swissy fell from 1.2 towards 0.8. That was intraday. You never see moves like that in FX.
But I want to look behind the scenes here just a little bit. So Switzerland was trying to weaken its currency effectively versus the fundamentals. And it kind of has infinite ammo there in a sense. It can print as much money as it wants and use it to buy up euros. But as the ECB had announced a massive round of quantitative easing, in effect, to defend the exchange rate floor, the Swiss National Bank would have had to buy up so many euros, so much Eurozone debt, that it would have ballooned its balance sheet. And the fear was that it would be holding a load of assets from other European countries that were going to weaken in value over time. It was a choice to break that floor.
So you can have lots of ammo in terms of firepower, but just not the appetite to buy the stuff you have to buy.
I always find it interesting to look at these central banks around the world, because I feel like the Bank of England is a kind of boring central bank. It plays with a straight bat. It gives forward guidance. It never really surprises us. The Swiss bank, as we said, sometimes surprises us dramatically. We know the Bank of Japan loves to surprise us in quirky ways. And there's a fantastic episode from Hong Kong where their monetary authority had a really unconventional means of defending its currency, and it paid off.
I don't know how they got away with this. I guess ultimately the central bank's actions are determined by the government. So the government must have said this was okay.
There are no rules in central banking, really. It's the Wild West. And this is 1998, isn't it?
So this was the time of the Asian currency crisis. So during that crisis, speculators were trying to do something which was a pretty interesting trade. They shorted the Hong Kong dollar, and at the same time, they shorted the stock market to profit from the damage of doing that.
So they were trying to force rates up, weren't they? By shorting the Hong Kong dollar, and then rates going up would have pushed down the stock market. Now, the Hong Kong Monetary Authority, the HKMA, had different ideas.
Well, they bought the stock market, which the Bank of Japan has also done, it has to be said. But they spent about 118 billion Hong Kong dollars, which is about 15 billion US dollars at the time. And they did that over the space of just 2 weeks. And that was August 1998. And they ended up owning roughly 7% of the entire Hang Seng. And I remember looking at the balance sheet of the Hong Kong Monetary Authority and noticing that they had lots of equity on their balance sheet. And I thought that's odd for a central bank to do that. And this kind of explains how some of that residual never disappeared.
Do you think it was a clever move? It seemed to work. I know at the time Greenspan, who was running the Fed, didn't like it. But retrospectively, he sort of applauded it, I think, because it did force the speculators to back off. The peg between the Hong Kong dollar and the US dollar survived. It still survives to this day. And I believe the Hong Kong Monetary Authority later sold the shares it bought, or a lot of them, at a profit.
Well, clever's always judged in retrospect. So, yeah, genius move. But of course, it could have gone very differently.
But what allowed it to succeed? It had massive currency reserves relative to the rest of the market, so the firepower was there. It had a currency peg that seemed to be genuinely defensible, and it had a sort of willingness to do crazy things and fight dirty and surprise markets by just going, all right, you want to short the stock market? We'll buy the stock market. Come on.
So, just drawing all of this together, there are certain things which determine whether one of these interventions will work. I think probably the most important one is to push in the same direction as fundamentals. If the tide's going out, you want to push things in that direction. Secondly, a really important one is how charming are your political leaders? Because if you can get your counterparty to agree to the intervention, it's much more likely to succeed rather than have you fight them. Firepower matters a lot. So if you're a country which has unlimited ammo, if you can print your own currency in order to sell it, well, weakening is something that you can do very easily as a central bank. Or if you're a country which exports more than it imports, if you have these reserves, you can use those huge reserves to defend your currency. And drawing a line in the sand, big mistake. Never do that because it just encourages speculators to say, yeah, I'll have a go at that.
Although I guess a peg, a currency peg, is a line in the sand, a very specific one. But we know how hard it is to manage pegs, and there's a long history of them breaking. So how do all these lessons apply then to this latest intervention in the yen? It was coordinated, at least between the US and Japan. The ECB will say it is not that coordinated.
It was politically backed at the highest level. Trump created Truth Social posts about this. And we've got all the FEMA machinery behind the scenes to allow Japan to sell some of its treasuries, but not sell them via the repo market, and that way get dollars to sell.
I think it does matter that they've signaled there's a way to do this again without causing massive collateral damage. But there's always unintended consequences, isn't there? But I guess the big fundamental reason that the yen has been weakening over the last couple of years is still there. The interest rate differential is pretty chunky. So the Bank of Japan's at 1% and the Fed's at 3.5 to 3.75%. And as long as that's true, it's going to be one force exerting downward pressure on the yen.
And I guess the other problem is that the US is an importing country. So it doesn't have huge foreign currency reserves, which it can use in order to buy yen.
Now, we said near the start that all of this stuff is not an academic exercise. It does matter for UK investors. But how does it matter? What are the implications here?
I think an important one is whether to hedge or not. And I think in many cases, people have chosen to hedge their Japanese equity position. The reason for that is when the Japanese yen weakens, it strengthens the stock market, and not hedging removes some of that benefit. That's why people hedge exporting countries' equity markets. But maybe the most important thing is to know whether you're hedged in the first place. If you have a global equity tracker, it won't be hedged for your Japanese yen positions. So this is a deliberate decision if you want to go down this road. And yes, the Japanese yen hedge version of Japanese equity would have worked so far, but will it carry on doing so? And I'm not convinced I could call it either way.
Over the long term, I think it's less clear that hedging equity markets makes sense.
And that's because equity markets over the long term drift upwards, whereas because they're driven by interest rate differentials, which don't drift, you don't get that happening with FX usually, certainly not over the very long term. So it's not usually worth hedging equity positions.
I think Japanese investors would have loved it if their equity market had drifted upwards over the long term. Maybe that's resumed now. It's had a good run recently. What are the other implications for investors? Anything else to be aware of?
The other point, I guess, is that you can't watch one of these markets in isolation. Bonds, currencies, equities. One of them will affect the others. And it's not always obvious the way in which they interact. So just understand that they are linked and they're often not easily predictable. And whenever you get volatility in one market, it doesn't usually stay isolated in that market. This is the interconnectedness point again. Volatility tends to spill between different asset classes, particularly when there are one of these really sharp moves, almost irrespective of what the source of that volatility is.
Do you think we could see another day where the Nikkei moves, more than 10% because of some dislocation in FX markets or bond markets or whatever?
I think so, and that's because we're moving between regimes, one in which Japan had zero interest rates to one in which it has normal interest rates in line with the rest of the G7.
Well, 1% at the moment. We'll see if it gets there. It's going to be expensive if it does.
Now, I mentioned I know about this and that it's a concern for people because we have a call every 2 weeks with all of our members. And if you wanted to be able to ask questions on that, it's one of the benefits of membership. To learn more, just go to pensioncraft.com/membership.
Okay, today's dumb question of the week. Why can't the government just pick whatever exchange rate it likes?
Well, the answer is that it can, but it comes with a cost. So we discussed, for example, the dollar peg for the Hong Kong dollar, which is pegged to the US dollar. Now, that peg's been in place since 1983. Another one is Denmark's currency, the krona, which is pegged to the euro. You often get petrostates pegging to the dollar.
So these are all countries where they effectively have picked an exchange rate and it's locked in place over time. But this all seems like one of those classic things in life where you can have anything you want, but you can't have everything. There's this idea of the impossible trinity, where a country can have at most two of the following three things. 1, a fixed exchange rate. 2, its own independent interest rate policy. And 3, free movement of capital across its borders. You can't have all of them.
And the reason why that doesn't work is because it's like the tide. If you're trying to fight against it, then it's not going to work. It's not sustainable. So let's say that the UK fixes the pound to the dollar, decided to keep all of the capital flows open. So you could sell pounds, you could buy dollars.
You can run away with a bag of money.
And at the same time, it decided that it wanted to control interest rate policy and that it wanted to cut interest rates while the Fed didn't. Well, immediately that's a problem because money parked in dollars is going to be paid more than money parked in sterling. So that means that the money would automatically leave the UK. Now, selling pounds pushes the pound down, and that would break the peg.
Unless the Bank of England buys every pound that's being sold. Why can't it do that? Why can't it just buy up everything to defend the peg?
I think the problem is the reserves are finite. So eventually that's not going to work. So that's why you've created this impossible situation.
The impossible trinity. Isn't that all more or less a description of what happened in 1992 when we crashed out of the ERM? We were kind of trying to have all three.
So really it's just a matter of choosing which one of those three you want to give up. Do you want your own interest rate policy, which is independent? Do you want free movement of capital? And most developed markets would say yes to that one. So it's really down to a choice between a fixed exchange rate and whether you want to control your own interest rate policy.
Yeah, that makes sense. So Hong Kong has no monetary policy of its own. It basically imports the Fed's, whether or not it suits their own domestic economy. But then China, on the other hand, which has more or less chosen to fix its currency, pick the exchange rate as it pleases, and have its own monetary policy, well, it's no surprise that it has capital controls. You can't take all your money out of China legally.
And of course, if we think about the history of currencies, it was the case that they were all fixed to one another for a very long time. In fact, this period of floating exchange rates is the aberration rather than the norm historically.
Are you thinking about the gold standard here?
Yeah, exactly. We used to just say, well, a dollar was worth a certain amount of gold or vice versa, and then everything was fixed relative to the dollar. Now, that created a great amount of economic pain, but people decided that that's what they wanted to do. Eventually, it broke down. It became unsustainable.
I think the thing people forget about the Bretton Woods era and the post-war monetary system where, as you say, everyone was fixed to the dollar and the dollar was fixed to gold at $35 an ounce. What are you sacrificing there? Well, generally, the answer was capital mobility. I think people forget that if you were going abroad on holiday, you couldn't take more than £50 in foreign currency with you.
So in the era of Airbnb, where so many people do travel, then I think that would be unsustainable. In those days, maybe there just wasn't much travel, so it wasn't such a big problem.
And £50 bought you a lot more back then, I think. This all ended, didn't it, this era in the early 70s, when we had the Nixon shock. And the US essentially decided that it wanted to run its own economy and not pay the price of everyone being pegged to the US dollar.
And again, when these things change, it creates huge amounts of volatility. And you see that in a variety of asset classes, equity, gold, rates at the time, all of these were affected and hugely affected.
I suppose the danger with any kind of currency intervention is that it becomes a little bit too much like the government trying to pick an exchange rate. Now, obviously, the US and Japan in this coordination weren't literally trying to say what they believe should be the correct convertibility between the yen and the dollar. But they were certainly arguing with what the market thinks it should be.
And when the BOJ intervenes, usually you get a 3% move when they do it, and it quickly fades away. What actually has happened this time is it has stabilized the currency, so far at least. So maybe you could call that a success.
Is the bigger point here that the numbers sound massive, don't they? Oh, they intervened to the scale of $80 billion. But when you compare that to the total FX turnover in a day, is something approaching $10 trillion. It's almost a drop in the ocean, isn't it?
Yeah, and I always make this joke about FX when you do interventions. It's a little bit like King Canute. Kings may come and kings may go, but the sea goes on forever.
Thank you for joining us for Many Happy Returns. Keep sending us your questions, no matter how dumb, at mhr@pensioncraft.com.
And do remember to check out pensioncraft.com for all the information about our membership, courses, and investment coaching options.
Many Happy Returns is a PensionCraft production, co-hosted and executive produced by Roman Nakiza and Michael Pugh. This podcast is for informational and entertainment purposes and is not financial advice. We do not provide recommendations or endorse any decision to buy, sell, or hold any security. We cannot be held responsible for any actions listeners may take, and investors are encouraged to seek independent financial advice.